Happy Finance Friday. Dave Schurman of First Ontario Credit Union. Back with more viewer questions. We've got 3 great ones. So let's start off with a question from Carrie in Hamilton. She has a question about tax deductions. She says, I live in Ontario and my employer is based out of Winnipeg, Manitoba. I completed a T1 for Manitoba, but she files her taxes in Ontario. The taxes deducted from my paycheck are based on rates set in Manitoba. Is that correct?
Well, thank you, Carrie. And no, it's not correct. Probably the reason is because she filled out the T1, which is basically a form that your employer gives you so they know how much tax to deduct based on your personal exemptions. But no, we pay all of our tax into the federal government, into the CRA. They keep about 2/3 of it, then 1/3 of it goes to the province in which you live. Not the province in which your employer is based in, but the province in which you live. Now, the good news for Carrie is the rates in Ontario are less than the rates in Manitoba, so they're actually submitting more than she's going to owe when she submits her taxes, so she will get some back. But the other thing, she could also let her employer know to deduct a little less based on her province of residence.
Okay, I had no idea there were differences there.
Yep.
Okay, next a question from Michael in Burlington, who says, I've been reassessed by the CRA. They now say my total income is higher and he owes more. He says, I received a retirement bonus of $40,000, was told if I put the full amount into an RRSP, I would not have to pay tax on that amount. Because the $40,000 was added to his total income, the CRA says he has to pay tax on his total income amount. He wants to know what happened there.
Yeah, Michael, so this one's a little tricky. And the advice he got was correct. The employer can put a lump sum, whether it's a bonus, in this case in Michael's it was a retirement allowance, doesn't matter. They can put it directly into an RRSP on your behalf without tax deducted. However, the paperwork has to be done correctly. If the paperwork is done incorrectly by the employer, so it's assumed, or it could be that you'd have access to the money, even though you didn't, then the CRA are going to make you pay taxes first and then make the RRSP deduction. Now, again, for Michael, you're going to get that tax back. Unfortunately, the CRA has access to those funds until you get it back, but you will get it back.
So is that a recourse then that he has to do on his former employer?
No. It's just when he files his income tax, he's going to have the RRSP receipt for making that deposit.
Okay.
But he's going to have to pay tax on the $40,000 because it appears that the employer did not deduct any taxes from the 40 either.
Okay.
It's just paperwork. It was done a little incorrectly. So just make sure when you're getting a lump sum bonus or a retirement allowance, make sure that your employer is doing the paperwork right and you get the full access of that full money without tax deducted.
Okay. Our last question this morning is from Kelly in Hamilton. It's about her savings. Good to have savings. Lucky you.
Yes.
I've maxed out on my TFSA for 2023. She's been making deposits since she turned 18 10 years ago, and she still has a significant amount of funds sitting in a savings account with basically no interest. She recognizes that in the next few years she's going to have lots of expenditures coming up and wondering what to do with that leftover money because she doesn't want to pay tax.
And I don't blame you, Kelly. Pay as less tax as you can. So Kelly's doing very well. I was very impressed with that email. Her age, 28 or so, maxing on her tax-free savings account. That's great. She didn't mention RRSP. Again, it's probably not the most important right now for her with, she mentioned a wedding, buying a house and things like that, having kids at some point. But you do want to start an RRSP at some point. One thing I would recommend for Kelly is a new product by the federal government called a First Home Savings Account. It was announced 2 budgets ago. It's like an RRSP in which you can deduct everything that you put in. It's a maximum of $8,000 a year, but it's like a tax-free savings account in that when you take it out to buy a house, it's the only thing you take it out for, you pay no tax. So that's where she may want to put those additional funds now.
Okay. All 3 great questions. Thanks very much for sending them in. And if you've got a financial question or a topic you want Dave to cover, email them to financefriday@firstontario.com or get in touch through Twitter @finance_Friday. If your question is covered on air, you will win a gift card from a local business in your community.